multi-employer pension plan approved by the regulator in the late 1990s. And today, we are still strong, secure, and are here for our employees and employers alike. If you would like to join or require further information, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense, bringing an informed financial perspective to the Cayman community.
Grant has joined us before, but to remind you, he is a prolific writer on markets with his own newsletter, which has a rather large number of letters, TTMYGH or something.
You can do it. Come on, you can do it.
Things that make you go, right? So TTMYGH, as well as operating a few other lines of business. So without further ado, let me say a very good morning to you, Grant.
Good morning to you. A nice early start for us both.
Oh, we do love the mornings, don't we? Tell me then, what are you up to nowadays? Because I said you're this writer and newsletter commentator. What else are you up to nowadays?
Well, do you know what? It's the lockdown has given us all this time on hands, but it's like a gas. I just seem to fill it with. I'm doing a lot of podcasting stuff.
You used to travel an awful lot, didn't you?
I travelled like you an awful lot, and that's come to a screeching halt for the last 9 months now, which is unfathomable to me. But I've been doing a lot of podcasts because I'm stuck at home, like you. I'm stuck at home, lockdown, nothing to do, and rather than sit there eating and drinking, I figured I'm going to have some conversations with some friends of mine and stuff. So why not record them and let other people listen in too? So we've been doing a lot of those, and they've gone over really, really well.
So that should make you a more esteemed commentator on the markets than even the more esteemed than you were before.
Well, steamed perhaps, maybe not esteemed.
Well, let's get right into the meat of the first topic that I want to touch with you: the markets.
Yes.
You know, that nebulous concept of markets. And they seem to go up irrespective of what the news is.
They do.
Irrespective of how depressing things are, whether there's a virus or whether there's a cure for a virus, whether there's an economic crisis or not an economic crisis, they're going up. Can you perhaps try to summarise why? I'll give you 3 or 4 minutes.
Yeah, that should be plenty. We can whistle tunes for the last minute. Look, it's very interesting because there are two things here. There's the market and the economy, and the markets used to reflect the economy. So if the economy was in trouble, the markets would be in trouble, and vice versa. And what we've seen now is markets that are reliant upon stimulus to go up. And of course, there is trillions of dollars in stimulus that's been thrown at this situation. And so, if this vaccine does come along, which it seems anyone reading the news would see that one of these is probably going to be successful at some point, there's an awful lot of dry powder in these markets. A lot of money been thrown at this problem. Trillions and trillions, $12 trillion globally so far. So the markets are floating higher on a sea of liquidity, but the economic data that's coming out, so we saw job numbers in the last 24 hours, much worse than expected. And so we're now into that dip. The economy seems to be rolling over. Does it mean we'll have more stimulus thrown at them? Possibly. But it's things like mortgage holidays. It's things like governments paying 80% of your wages and keeping you at home. That's the kind of stuff that is going to be very difficult for governments to pay for, and they're having to start looking at ways to pay for this now. Your UK Chancellor of the Exchequer,
yeah, and then that's the question. It doesn't matter to my mind. There's a question of trillions are big numbers, however many of them there are, and that's lovely. It gets markets all excited, and it puts cash into people's pockets to deploy into markets. But you've got to pay the piper at some point. So when does this come back to haunt people?
Well, look, we're at that point now, really, because the initial stimulus has kind of faded. A lot of these programs have expired. Some of them are being renewed. Some of them they just realised they can't afford to renew them.
And
so
the Treasury Secretary in the US just took some money back from the Federal Reserve.
Correct.
You've had enough.
Correct, and that may be a political move, in fairness, but at some point, if these jobless claims keep going up, if the long-term unemployment keep going up, they've got a choice to either put more stimulus on there, which is going to require more borrowing, which is going to weaken credit rates. There are so many aspects in play here, but I think it's important for people to understand that the markets right now they have a backstop. That if the economy gets weak, the government and the central banks have proven they will support. They do everything they can to support the economy, and what that means is the markets. So everyone's very bold now that the markets, to your point, it was a light-hearted remark, but it feels like the markets go up every day, and that sucks people in who've been sitting at home getting checks from the government. And if you look at day trading, you look at phenomena like Robinhood, the people who've opened millions of accounts of stock traders in the US, particularly in the last 6 months, and they're just putting those checks to work in the market, and it does have an effect. It absolutely does have an effect. So at some point, markets will reconnect with the economy, and if that happens at a point where the economy is in dire shape, then markets are unquestionably overvalued. But for then, people are riding the tiger.
I guess there's this word that is used in market analysis, momentum,
Yeah.
which is once something starts to build up ahead of steam, it starts to go up or go down, it tends to be that people follow that trend, and that's what we're seeing a lot here. So there's very smart systematic type strategies and other hedge fund strategies which follow this momentum play and monitor where capital is being deployed. And that's kind of what you're saying there. Part of the reason for markets having been as excitable as they have and has been as elevated is because people are just chasing where the recent money has gone, and the recent money has gone into markets, and so therefore more money follows it.
Yeah, that's very true and well put. I mean, you also have these passive strategies where people just invest money, and it goes into
prevalent now.
increasingly
So
prevalent.
More and more people are allocating. So if you're allocating to an S&P 500 tracker, and that's your pension, well, pensions generally have increasing assets each year because there's more and more people in the world. So that means that more money is chasing the S&P 500, whether it's good or bad value. They're obliged to.
Yeah, and of course the flip side of this that people have to bear in mind is this momentum works in both directions. We just haven't seen it to the downside for some time now. So if we get that moment where the economy and the markets reconnect at a point in time where they realise either the central banks can't afford to bail anybody out, the governments can't afford to borrow anymore, interest rates start to go up, whatever it may be, if that momentum switches, it becomes a big problem because it does work in both directions. And once markets start going down, as we saw in March, they go down much faster than they go up because, I've talked about this before, but you have these two, fear and greed, which rule the markets. Everybody is afraid. Not everybody's greedy, but everybody gets afraid. And so when they go up, you've got all the greedy people piling in and they gradually sort of suck people in from the edge. When they start to go down, everybody gets afraid, and that's why you get these precipitous drops. So if momentum reverses and we see markets start to go down, that will feed on itself much quicker than we've seen this phenomenon feeding on the upside.
The origin, in some respects, of this scenario we're in is encapsulated, I think, quite well by something that used to be said in the late 90s, the Greenspan put.
Yeah.
Which is, if you were worried about something, don't, because Alan's going to save you. He's going to put whatever money needs to, and that, in some respects, led to the dot-com bubble, led to the technology boom, with people just saying, well, who really cares about valuations, because Uncle Alan's going to bail me out if it all goes wrong. He's going to help make sure things are okay. But as you say, once fear came into the equation for reasons that are still in some respects a little unclear as to what the trigger was, things went wrong quickly.
Yeah.
So what's the trigger that could happen now? I mean, one of the things that I thought, one of the unique areas that's happening right now is there's a lot of money chasing private assets.
Mm-hmm.
So a lot of companies that 20 years ago might have gone public in order to raise capital just don't do that nowadays. They're continuing to raise private capital from the SoftBank group as one example. And then SoftBank had that big calamity with not really working, WeWork. So it had issues there. And I thought perhaps that would be the sort of trigger which would say some of this capital deployed in private capital markets has been so inefficiently done so. But it wasn't.
Well, think about the timing of that, though. Think about when that happened. It happened really not that long before lockdown occurred, not long before the pandemic struck. So had we not had $12 trillion thrown at markets in form of stimulus across the world in these last 9 months, who knows what might have happened? And that's, I think, the important point to notice, that you're absolutely right. That stuff is going to matter at some point. But while the markets are floating higher on an ocean of liquidity, which is what's happening, it doesn't matter for now, because people make the exact same assumption you talked about there with the Greenspan put.
So let me try and phrase my next question. I don't want to be too indelicate here, but you and I have talked before about, if we're talking liquidity and we're talking momentum, there's one perhaps great white elephant that's sort of sitting in the corner of the room, which I don't want to put it too mildly, but you've been slightly critical of before, and that's Tesla.
Say it, Simon. Say it. Don't be shy. We're all friends here.
It's the listeners we're worried about. You never know whether Elon's listening. But it's the largest ever market cap entrant into the S&P 500. He's now, because of the rise in its share price, the world's second richest person, although that's a bit of a misnomer because the richest people have given away half their wealth already. So what's going on with something like that? It is making cars.
Yep.
There was some ambiguity as to whether those things they were making in the tents in the car park were actually cars or not, but he is making them. Is that a symptom of this liquidity boom, or is it actually we were just wrong about
Well, let's split two things apart. Let's split the company and the stock price. Okay, let's put them aside as two different entities, because they are. I mean, as I put back to my earlier point, this used to reflect economic reality. If you look at Tesla's market cap, it's worth something like 2 times the market cap of the entire automobile industry worldwide. And they sell less than 1% of the cars sold worldwide. So if you just look at that one metric, look at the size of the company, the size of the market, the size of their share of the market, and then their valuation versus the rest, of course it makes no sense whatsoever. But the stock price is going up, and it has kept going up, and it's in the right space, it's in the green space, it's ESG, it's electric cars, it's all these things, and it has a charismatic CEO.
It's ESG, it hasn't got the G. That's
well, yes, yes, very good point.
There's no G in
a very good point. But it's a story stock, and particularly to our point earlier on about the people who are just day trading and throwing money at markets. What's going up? Tesla's going up.
And so more money
comes in. Being wrong about the stock price and being wrong about the company are two different things. And so myself and every other Tesla bear in the world has been catastrophically wrong about the stock price. We're not at the end of the story with the company yet, and that continues to evolve. The competitors continue to come into the space all across the world. Their sales continue to fall. If you could find any analyst of who's any tenure in the stock market to analyze the company, and he would tell you it is overvalued. But the stock price is the only thing that people matter about. Yeah, no, of course. But because it's going up, and you don't want to put a sell rating on something that's keep going up. So it's for now. I mean, it's fascinating. I haven't had a position in the stock for some time now. I got chased out of it, and I'm watching from the sidelines, just fascinated to see how this ultimately ends, because it will end in either the valuation being proven correct, the company being shown to be some kind of fraud or a Ponzi scheme, or it being the biggest car company in the world by sales, in which case it will have to sell about 300 times as many cars as it can at the moment.
Flying cars and all that.
Yeah, it's a fascinating story for people to follow.
One of the things about Tesla that intrigues me in some respects is it's not only had a distorting impact on equity markets. I was looking the other day at convertible bonds, and let's not go into the nuances of why. It's just a rainy day in Cayman, so I thought let's have a look at some convertible bonds. One of the best performing equities that are out there is an ETF that tracks convertible bonds, and the reason because a lot of the convertible bonds are Tesla convertibles.
Yep.
And so people who are investing and thinking, hey, looking at things that have gone up, this is not by any stretch of the imagination a convertible bond which is ever going to convert. The share price is gone through that. But you have distortions happening in places in the market that you ordinarily wouldn't think of. You have bond markets being distorted by Tesla's share price. That's a really strange scenario to be in.
It is, but if you think about the root of all this, what's the root of capital markets? It's the cost of capital. And the cost of capital through interest rates has been manipulated to zero for a decade now. So if you corrupt, and I don't mean to use that word in a pejorative sense, but if you corrupt the cost of capital at the very bottom of the market pyramid, you corrupt everything that gets layered on top of that. And so that's where we're at. Should the interest rate be zero? Should there be negative interest rates? There's $17 trillion of negative yielding debt in the world. Be great for the government. I mean, the Greek 3-year bonds went negative, if you can imagine that. Should that be where it is, given natural market forces? Of course not.
Why though, do we see these scenarios playing out in the US, in the UK, in Europe, in Canada, and yet somewhere like Japan, which had negative rates, basically, as far back as most of us can remember, why is that scenario also not played out there with speculation of money flowing into the assets, driving them ever so high? I mean, a lot of Japanese assets are trading below price to book, and these are often intrinsic companies as opposed to intangible type companies.
Yeah, Japan's an interesting one. I lived in Japan 30 odd years ago at the height of the bull market there, and it was as fascinating to watch at the height of the bull market as it is to watch now in the depths. Well, I say the depths of the bear market. It's finally certain indices have finally got past their 1989 highs. We are almost 30 years later. Japan's slightly different in terms of the way the market's structured and the way the bonds are owned, and it's a long discussion to get into, but it's a great roadmap for central bank policy and what they're likely to do next, but it's not necessarily a great comparison. It's apples to oranges when you look at the structure of US capital markets and European capital markets. So it's a discussion for another day, because we could take up the whole 30 minutes talking about Japan.
Well, we won't do that, but we will take a very short break just to pay our bills and then come back and talk a little bit more about markets with Grant Williams.
The Cayman Islands Chamber of Commerce Pension Plan. We're here for you. Did you know that since May, in support of the COVID-19 Emergency Withdrawal Program, the Chamber Pension Plan leveraged IT and human resources to successfully review over 16,900 member applications, approve over 12,579 applications, and will pay over CI $143 million to our plan members. We are the Cayman Islands Chamber of Commerce Pension Plan, and we're here for you. For further information regarding the Chamber Pension Plan, visit chamberpension.ky. And for information as it happens, follow us on Facebook, LinkedIn, or Instagram. Email admin@pensions.ky or call 745-7630.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
We touched on Japan. Let's just spend another couple of minutes on Japan, because it's a genuinely fascinating area to me. It seems as though it should be a role model for the perils of momentum, the perils of just buying what's going up. But no one's following that sort of models. Why is it so different?
Well, Japan's so out of vogue now. I mean, it's been a dead market for most people for 30 years. It's starting to show signs of life, and I think it'll actually be a very good place to invest, because the companies have gotten themselves in much better shape because they've had to. The problem you have over there is this deflationary mindset in Japan. You know, that Japan bull market that ended on December 31st, 1989, they never had a crash. You know, the market was going up for 10, 15 years.
The fear, then the panic.
Well, no, it just kind of toppled over on its own weight, and it just kept going down. It's been going down for 20 odd years with the odd rally in between. And so it's become entrenched in the mindset over there. They haven't had what the US has had in terms of these great outbursts of euphoria and people chasing hot stocks and things going up. They just haven't had that on a market-wide basis. So you do have to shift that mindset. Plus the demographic. I mean, Japan is a much, much older society, and net the population is declining now. So they've got structural issues there. They've got a bond market that is essentially wholly owned domestically, which gives the central bank much more ability to control that, because foreigners don't own the government debt. So it's a really interesting place to study. As I said, mostly for what the central banks in the rest of the world will do next. You can't then extend the comparisons to if the Bank of Japan bought the ETF market in Japan and it didn't do anything dangerous, we can do it here, because they're completely different beasts. But they bought government bonds. They went to negative interest rates. They've started buying stocks and ETFs. And that is the roadmap for every other central bank in the world, because they're all following the same playbook just 20 years later.
Which then leads to the question, if we sort of see what the roadmap is that the central banks are doing, is there something different that we as investors should be looking at? And that then leads to the question, well, people start to buy alternative types of assets. They buy the gold. They say, well, central banks are devaluing the value of our fake financial assets, therefore we'll buy this gold. We're worried about this precipitous amount of debt, which typically makes people panic about inflation. Is that the reason that people are buying things like cryptocurrencies, or is that another momentum issue? And why are people buying those as opposed to gold in today's climate? Because it seems as though if you're trying to protect yourself from central banks and governments debasing your standard of living through currency manipulation in one shape or form, that's what people historically have gone and bought. So what's your explanation for what's going on there?
Well, I think first of all, I'm amazed you took 20 minutes to get to Bitcoin. That's very lax of you.
Adam's
Yeah, right. But what people really need to do is think about whether they're speculating or investing. Right. If you're investing for your future, then you have to look at the big picture, because it's the big picture that drives the future. And we've talked about some of the issues that the world is facing right now, and these are long-term structural issues. So if you're investing, then you have to be aware of the damage that those structural issues can cause to your portfolio, and they can cause some severe problems to your portfolio because of the overvaluation levels we described. If you're speculating, then this is a great time to be a speculator, as long as you understand that at any moment someone can pull the rug out from under this thing, and if valuations become important again, which they will at some point, the rug could be pulled and this market could fall very far very quickly, as we saw in March. So yes, people should be thinking about the damage that's being done by $12 trillion of borrowed money being thrown at markets in an economy that's, where GDP has suffered 30% hits in some countries. That GDP becomes a huge problem. And so they are looking at gold. They're looking at Bitcoin, because we didn't have Bitcoin in the 70s when we had a last inflationary scare, for example. We do have it now. But again, with Bitcoin, it does offer those properties that you talk about in terms of potentially protecting you against government spendthriftery, if there is such a word. But it's not a tested store of value. And if you were looking for something to protect the value of your purchasing power, which gold has done for thousands of years, then Bitcoin for the last 4 weeks has done a fantastic job of increasing your purchasing power. For the last 15 hours, it's done a terrible job of protecting. So it's very new and it's very volatile. And so I think this run we've seen is much more speculation than it is people actually saying, I'm going to commit some of my long-term savings to Bitcoin. At the fringes, absolutely that's happening. In the mainstream, are people saying, I'm worried about the value of my currency and my purchasing power, I'm going to buy Bitcoin? I don't think that's what's driving this.
I remember, I think it was a couple of years ago now, a person who shall remain nameless, a squash buddy of mine,
phoned me up when I was off island and said, should I be buying some Bitcoin? And this was during the euphoric rise of Bitcoin part
December
1.
17, yeah.
And I said, well, I don't think that's a very good idea, frankly. I'd probably say the same every day since, but that's neither here nor there. They didn't. But it seems to me we're sort of back in that mindset right now of people, this thing's gone up a lot though, Simon, shouldn't I be buying it? And I often make the joke that I wouldn't typically go and buy something from a supermarket or from a store that's gone up just because it's gone up. I typically buy it when it's on sale because it's better value for me, and yet people are buying stuff which has gone up precisely because it has gone up.
Right, but you're buying that stuff from the supermarket to consume it. Mm-hmm. These people are buying it with the hope of selling it to someone else at an even higher price.
But that comes back to the greater fool theory.
Absolutely.
Can you guarantee that there'll be someone more stupid than you who will buy this? I'm not saying everyone who buys it's stupid, but who is more stupid than you who will buy this thing at a more expensive price? Lots of these people don't know why they're buying it in the first instance, other than they hope to sell it higher.
Correct. It's just pure speculation, and that's fine, right? There's a place for that.
Do you think it needs to exist? Has it a use?
Look, I think it does. I'm in the process now of trying to get a better understanding.
Are you becoming a millennial?
No, that'll never happen, sadly. I have 2 of those in my household, and God knows that's hard enough. But I think people need to try and understand Bitcoin, because what fascinates me is people I have incredible respect for, very, very smart people, are on complete opposite ends of this. Some think it is the savior of the world, the greatest thing ever invented, and some of them think it's a complete Ponzi scheme and has no value at all. And each of those opinions, based on who's offering them, deserves consideration. So I think it's important for everybody to actually not just decide, it's a Ponzi scheme or it's the greatest thing in the world, but try and understand it better and then make your own mind up, because somewhere in there is the truth, and it's somewhere between those two things, I suspect. But right now, it's such fast-moving technology that to try and understand it and keep up with it is a major commitment. And that's, I think, the problem most people have. So they see the price going up every day. I don't want to take the time to understand it, but I can see it's going up, so I'm going to jump in. And that's, as we saw last night when it fell $1,000 in a matter of minutes, that's what these things will do.
Is it fair to say that Bitcoin has become more mainstream because of the amount of debt that's being created by central banks and governments, and that if we lived in a Swiss-style world where there was no real debt and everyone was very organised and orderly, you wouldn't have this panic need for people to invent something which was protecting from what they thought was nefarious government action, or am I too far on the fringes there with that?
No, I think you're not on the fringes, but I think you've oversimplified it. I don't think it was invented for that reason. It wasn't that at all. I think if we lived in a Swiss-style society, Bitcoin may well still have been invented, but would we have seen the rampant price speculation in it? Probably not. It probably would have been a much steadier growth in acceptance and a much steadier price chart for one thing.
Would you think gold would have behaved differently in the last 4 years? Were there no Bitcoin and nothing for people to consider this alternative asset?
Do you know, it's a great question, and the simple truth is we don't know, but I think it's safe to say that a certain amount of money that perhaps would have gone into gold has gone into Bitcoin. Neither market is that big compared to some of the other asset markets, so it's not really moving the needle at this point in time. And of course, Bitcoin is a very simple thing to sit and buy. You open an account on your phone and you press a button and you've bought Bitcoin. Gold, if you want to own the physical asset, which if you're buying it for those protective reasons, you want to own the physical asset. There's a lot more that goes into that, and it's a much more laborious process. Now, that tends to make people far more reluctant to sell it, because they have to go through all the same hoops again to sell it. So people tend to buy the physical gold and hang on to it, and they don't focus on the price fluctuations so much. So I'm sure there is some money that has gone into Bitcoin that would have gone into gold, but has it made a massive difference at this point? I doubt it, to be honest.
Now, we've got about a minute left of questions, and without putting you on the spot and not having pre-warned you for this, who's going to be sworn in as the next US president? The reason I asked that, there's a little bit of backstory. Grant and I had a bet as to who this might be.
We did.
I'm thinking I've got a chance of winning this one now.
I think you do. Although, what's very interesting is even today in the UK, you can get odds of 28-1 on Trump taking the presidency. Now, if you think about what's happened, those are very low odds. Yeah. 28-1 for someone who has lost by millions of votes, has had everything just about certified.
There are horses with 3 legs in races that have 1,000-1 odds.
Exactly right. So it's very low. I think it would be an extraordinary chain of events for Biden not to be sworn in. But the way this whole thing's played out, I mean, until he actually stands on the steps and holds the Bible in his hand and
that
swears on it.
Gets into the White House there.
Well, maybe not. But this is not over till it's over. But it will be such a long shot for Trump to turn this thing over.
Do you think it matters to markets? I mean, is it really just, frankly, news and just distraction?
Yeah, look, I think it will matter to markets when, let's assume Biden takes up the role of President of the United States. I think his policies will matter a great deal to markets, but at the moment the markets have celebrated the kind of the reduction in volatility, the calmness, the sense of order. I think that comes back. But Biden's policy, I suspect, will worry the market a great deal at some point.
That's coupled with all the other worries that are out there, whether it be valuation and all other things, could be the making of a fun 2021. I think
if you're just worried about price, nothing to worry about. If you're worried about long-term protection of your savings, there is plenty that you need to take into account.
Well, there's always an optimistic tone to end on. 2020 wasn't bad enough. Let's hope for a worse 2021. Yes, viruses and all other things permitting. Look, Grant, it's been a real pleasure having you on the show. It's been a fabulous but ever so brief conversation. Thank you very much again for joining us.
My pleasure, my friend. Anytime.
Thank you. Now, as a final note before we leave, just want to remind all of our listeners that today's show will be available as a podcast on the CFA Society Cayman Islands webpage, and encourage you, if you have a question or topic that you wish us to cover, then do, of course, email us at moneysense@candw.ky or tweet us at MoneySenseRadio. That's at MoneySenseRadio. With that, thank you once again. Goodbye, and please do tune into Money Sense in 2 weeks' time.
The Board of Trustees of the Chamber Pension Plan invites our members to attend the annual general meeting on December 2nd at 6:30 p.m. The meeting will be held at the Chamber of Commerce Boardroom in Governors Square. Join us as we welcome our new trustees, provide performance updates, and facilitate a question and answer segment. Refreshments will be served. Please visit our website, chamberpension.ky, or email admin@pensions.ky for further details. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Sense is brought to you by the Chamber Pension Plan. For further information,